Most people think they're beating the market, and most people are wrong. We're about to unpack one of the oldest debates in investing, and the answer might genuinely change how you think about your money. Let's set the stage. Active trading is the idea that you can buy and sell frequently enough, smartly enough, to outperform just holding. It sounds reasonable until you realize that even professional fund managers with Bloomberg terminals and Ivy League degrees to fail to beat a simple index fund roughly 80 to 90% of the time over a 10-year period. Think of the market like a casino, where the house edge isn't the broker, it's your own brain. Every time you trade, you're paying transaction costs, triggering taxes, and battling a psychological cocktail of fear, greed, and overconfidence that quietly bleeds your returns dry. Here's the historical gut punch. $1 invested in the S&P 500 in 1980 and left completely untouched would be worth over 70 times that amount by 2024. Meanwhile, the average active retail trader underperforms that same index by roughly 1.5% to 3% annually, which sounds small until compounding turns it into a devastating gap over decades. We all remember the meme stock era of 2021, when everyone online was a genius and your cousin was up 400% on a video game retailer. Then, 2022 arrived like an uninvited guest, and suddenly those same portfolios look like crime scenes. The psychological damage of active trading is real, and it's been studied. It's called the disposition effect, where investors sell winners too early and hold losers too long, doing the exact opposite of what logic demands. Even George Soros, one of the greatest active traders in history, once said that it's not whether you're right or wrong, but how much you make when you're right and how much you lose when you're wrong. And most of us are terrible at both sides of that equation. History rhymes embarrassingly well here. The dot-com bubble, the 2008 crash, the crypto collapse of 2022, each one felt brand new. Each one was a remix. The investor who held a diversified index through all of those events still came out ahead of the trader who tried to time every single dip and recovery. A common misconception is that buy and hold means doing nothing. It actually means doing the hardest thing, which is resisting the urge to act when every instinct screams at you to move. Passive investing isn't lazy, it's disciplined. And discipline in markets is rarer and more valuable than almost any stock pick. Now, let's talk real numbers. Studies from Dalbar, a financial research firm, consistently show that the average equity investor earns roughly 2 to 3% less per year than the funds they're actually invested in because they trade in and out at the wrong times. Over 30 years, that gap doesn't just shrink your returns, it can cut your final portfolio value nearly in half. The practical lesson is almost boring in how simple it is. Invest regularly, diversify broadly, keep costs low, and do not touch it. Warren Buffett has literally said that his favorite holding period is forever. And the man turned roughly $10,000 into roughly $30 billion. So maybe we take the note. If you insist on active trading, treat it like a small business with strict risk management. Never risk more than 1 to 2% of your capital on a single trade. Keep a journal and measure your performance honestly against a benchmark. Most people who do this exercise for the first time discover they've been losing to a boring index fund that requires zero effort and zero skill. The deeper truth here is almost philosophical. Markets reward patience and punish impatience. And the entire financial media complex is built on selling you the illusion that activity equals progress. The irony is that the best investment strategy in history looks, from the outside, like total inaction. Whether markets go up, down, or sideways this year, the investor with a clear plan, proper position sizing, and the emotional discipline of a monk will almost always outperform the trader refreshing their app every 20 minutes. Consistency isn't glamorous, but neither is explaining to yourself why you sold at the bottom for the third time. So build your strategy like it has to survive a crash, a boom, and everything in between, because it will. The edge isn't information or timing. It's the boring, unsexy, deeply human ability to stay in the game long enough to let compounding do its work. And if you're ready to put that same long-term discipline to work in real estate, renovation projects, or finding the right lender for your next investment, Check out our links in the description below. We can help you get started.